Hey, Kyle, welcome to the show. I appreciate you being here.
Thank you, Lacey, for having me. It's an honor. I'm really excited to be here this morning.
Well, this is a hot topic always in
Absolutely.
our community
Always.
is the
Always.
survivor benefit plan or the SBP as it's more commonly called. Can you explain to people that are not familiar with it what it is and what it's actually designed for?
Great point. Let's start with that. And what I like to start with when I talk about Survivor's Benefit Plan, because I think this gets lost, is this is not something unique to the military. It's unique in the sense is there's not many pensions left in the private sector. But this is a rule that applies both to defined benefit plans outside of the military and obviously the pension. Now, what we have to understand is the federal government requires that there be pension insurance. That's what you need to think of it as. It's pension insurance. Because oftentimes the thought process went is that you work so long in a company, you earn this benefit. And oftentimes there's not a benefit outside of it. So these rules were developed way before there was a 401k. And let me think about this real quick. Congress wanted to protect this. And there was a separate set of rules set up designed for the military pension by itself. But the federal government requires that all pensions offer at least 50% benefit for some reduction in your pension to ensure that the survivor is protected, the spouse in this case.
I think that's really important that people know it's for the spouse. And that's
100%.
yeah, that sometimes people aren't tracking that decision actually ultimately comes up to the spouse and they have to sign off on that decision when a service member is retiring.
Absolutely. And that's one of the fundamental caveats that before we talk about a framework of how to think about the survivor benefit plan, we need to think about the spouse first because that is their benefit. Now, when it comes to survivor benefit plan itself, the service member, retired service member in this case, forgoes 6.5% of their pension pre-tax to receive their spouse in this case, or their survivor, could be the children as well, 55% of their pension for the remainder of their life. So again, it's designed to protect that stream of income for the surviving spouse and or children of the retired service member.
In our community, people have very strong opinions about the
Me too.
survivor benefit plan. It is
I've come across those. Yes.
yeah. I was just thinking of a way to, like, explain it like Coke versus Pepsi, but I don't think that does it justice. I'm gonna have to think about another analogy, but some people are, like, for it, some people are like, "No, that's crazy." So one of the big things that people discuss is electing the survivor benefit plan or getting term life insurance. So before we kind of go into all that, like what are some of the pros and cons of electing to have the SBP?
So even before we start with that, I think we should lay down some facts first about the plan because and this is why I think it's such a controversy is because oftentimes when I hear of discussions of the survivor benefit plan, it goes right to cost. And before we do that, what I'd like to do is just outline a few baseline things that we can all agree on. Number one, and you already hinted at this, it is designed for the surviving spouse. It is their decision more so than it is the service member. Hence why, if you decline it, you have to actually get that notarized because it's a protection designed for them. That being said, when we talk about the different options, and we're going to get into it on term insurance, survivor's benefit, and term insurance, and all the different options, I can give you, and all financial planners can do this, a very thought out, detailed, mathematical right answer based upon your situation. But personal finance is more personal than it is finance. And we have to be cognizant of how the spouse feels about money. It could be a very clear, cut and dry decision that foregoing the survivor's benefit plan makes sense for a particular family. However, if that spouse has certain values around money that makes them predisposed to want that mailbox money, and have a steady paycheck, well, then it's probably the right decision. It's a little bit like, do I pay down my low interest rate mortgage, or do I invest the money? There's a very solid answer based on your mortgage rate on which makes sense. Some people, they don't sleep well at night if they have debt. And the mathematical right answer is to invest that money. Survivor benefit plan is no different. It really should be, it should start with that. And when we start to think about this, if you can't get past that, your decision's really easy. It's take it. Now, if it's, I feel indifferent, I want to make a decision that's informed by our personal finances, well, then now we can start to move forward and start to explore those. So that's point one. Point two is life insurance and the survivor's benefit plan. It's not apples to apples. It's apples to oranges. That's a very important distinction. And so I wanted to talk about that briefly. Survivor benefit plan is metered out in monthly increments. Life insurance is lump sum. Survivor's benefit plan is adjusted for inflation throughout the survivor's lifetime. Life insurance is not. And so the value of that life insurance gets eroded over time. In addition to that, if we're talking about term insurance, it expires. Survivor's benefit plan does not. Fundamentally, it's not an apples to apples decision. And so the framework that we're going to walk through today tries to control for that. And by identifying where there are similarities, but also where there's differences so that we can try to make an informed decision.
You made a good point there about the lens you're looking at it, or that's the way I interpreted it. Some people, it's like you have to be able to sleep at night. So if you have a very low risk tolerance, like you said, mailbox money might be the better way to go. But I think that's what happens is people are looking at it through a different lens and they're like, this is all about the money. Like it's a better financial decision to not do it, or it's a better financial decision to do it. And there's other factors like the ages of the spouse. Do they have a large gap? Some people have a spouse that's active duty that's 20 years older than them. So that's looking a lot different compared to high school sweethearts that are the same age and, have kind of grown up together, same lifestyle, those type of things. Lots of different factors. But what is the main argument for having term life insurance? Like, is it, hey, I'll take that money and invest it instead
It
of
is.
putting it into the SBP because you have to pay for it.
Absolutely. The main driver around the SBP argument is about fundamentally cost. And I want to get us to cost, but I don't think that's the right starting place, because a decision based only on cost that doesn't take into account value that's received, and more importantly, what you're trying to protect, misses the whole point. Because oftentimes what I see when people have made a decision on survivor's benefit only on cost, again, it's not an apples to apples comparison. The apples to apples comparison is on cost. So if, survivor's benefit for a retired service member is $5,000 a year, but their $1 million term policy is $1,500, they'll say, well, I saved the delta. Well, you did, but you're actually
Difference.
underinsured. Yeah, the difference between those two. So obviously you saved $3,500, but you're probably grossly underinsured. And so, yes, it's a savings, but at the expense of ostensibly what you were trying to protect. And so what I like to do, and the framework that I've developed with, is let's understand first what needs to be protected.
So that's the framework. The first step of it is to
The first step of the framework is what we discussed first, which is let's identify what survivor's benefit is intended to do. It's intended to protect the spouse, and they have a vote. They have the preponderance of the vote. And then two, let's first identify what the difference is between survivor's benefit, inflation adjusted, lifetime benefit, and term insurance, which is it expires and it's not inflation protected. With those two facts, Now let's talk about what needs to be protected.
Okay, so what would be some examples in the next step of what needs to be protected? Like your
Yeah, exactly.
retirement or
This is
special needs children?
so what needs to be protected is the value of the pension. And so oftentimes when I hear the pension discussed, it's in terms of a monthly benefit. And I like to flip that on its head. Another way to think about the pension is like a inflation protected bond backed by the full faith and credit of the United States government. And if we were to think it like that and use bond math, what we would have to do is create a bond in your retirement portfolio that produced that same level of income. So here's a few examples of that. So if we're looking at a colonel's pension, which is somewhere between $110,000, $120,000, if we were to have a bond in the portfolio that produced that same amount of income, that retiring colonel would need a bond in excess of $2.75 million over his or her lifetime to produce that same stream of income. That's super important to understand because in order to do a one-for-one replacement of that pension, you would need term insurance today of that 2.75 to maybe a little bit over $3 million. And the way that works is you take the annual amount, you take a discount rate. I typically use 1% because it's a very low risk. I adjust it for taxes, take it out to age 100, and we can have some debate on what age you take it out to. But that gives us a good ballpark figure of what the value of the pension is. For example, a lieutenant colonel whose pension is somewhere between $65,000 to $75,000 annually. The lifetime value of the pension is between 1.75 and $2 million. And if we're talking about a pension around 40K annually, lifetime value of that is between $1 million and $1.25 million. And that's just looking at the pension. We haven't figured disability into that calculation. The value of disability is even more because it's tax-free. And so I often see retirees coming to me in my practice that have $3 to $4 million of lifetime benefit wrapped up in those two pensions. Additionally, we haven't even considered yet the lifetime value of their human capital, which is just their annual salary valued the same way. Now, obviously, we'd use a higher discount rate because there's more volatility associated with that. Whereas we value the pension like a bond because it's very low risk, backed by the full faith and credit of the United States government. Your civilian salary is not, so we use a higher discount rate, so it's a little bit less valuable. And so it's not uncommon for a retiree in their 40s, starting out in the corporate world, when you combine the lifetime value of their pension, their VA disability, and their human capital, their lifetime income, lifetime value of their wealth is in excess of $5 million. And so let's just isolate the pension right now. But as you can tell, if we're talking about protecting our family, there's a lot of actual protection that needs to happen. And so the survivor benefit will replace 55% of that. But what type of term policy would we need to actually protect the whole thing and for how long? And so when we start to frame it in this sense, it helps us identify what different risk we're accepting by declining or taking it and not adding term insurance, or taking it and adding term insurance onto it. But if you don't understand what the lifetime value of the asset that you're trying to protect, we can't have a discussion about cost. And so when we frame the decision that way, when you understand that the lifetime value of your pension is $2, maybe $3 million, well, now that $1 million term policy that we thought we were saving money on doesn't look as good.
Yes. Plus, you'd have to be able to afford that term policy of that
Bingo.
size. And
Bingo.
that probably is going to be a little bit more expensive than what you'll be paying out monthly for the SBP.
Exactly. And this is where we also have to start to take in consideration our unique family situation and the ability of our spouse to potentially return to work and earn additional income. And so in a lot of cases, because of moves and because of military life, the spouse will be underemployed. Even if they're underemployed, we might be in a high cost of living area. And so now we have a large mortgage. And so if we start to think about, well, I'm going to decline survivor's benefit plan and I'll get a million and a half term policy. But if you have a $500,000 mortgage, well, that needs to come off the top. Maybe you have kids that are on their way to college. That's another expense. And all of a sudden, you've really kind of left your spouse in a very precarious situation where now there's not a steady stream of income. They have to return to work. What's their earning capacity? It's not going to be what the service members was. And now they have all these bills that start to get larger in your 40s and 50s. And so that's the framing that we need to start with when we talk about the survivor benefit plan, not the cost. And when we start to do that, it informs how we think about the cost and then also the return on investment that survivor benefit plan, given the cost, is actually worth.
What do you what you see in your practice when you really break this down, this framework, and explain like the lifetime value, what a term policy, what size term policy that they would need? Because I don't think most people realize that it would be such a large policy.
Mhm.
Where do people end up deciding?
So I like to frame it in a few different ways. The first option, it's just survivor's benefit plan and maybe VGLI and something like that. And that's kind of where people start to think at. And that's when we start to think about, okay, all of these other things. And ultimately, some of this is dependent upon the size of the pension. So if your pension is on the lower end between $40,000 to $60,000 annually, we can really think about potentially declining and taking survivor's benefit, or declining survivor's benefit and taking term insurance, because the size of the term life insurance policy tends not to be too prohibitive. And so usually what we'll end up doing if the person wants to decline is get somewhere between a 1.5 to 2.5 million dollar term policy. And then we'll layer on group policies on top of that from their workplace. Because the fact of the matter is we need to be able to, insurance is designed to protect where there's a low probability event, but high likelihood that it would be, the consequences of which would be catastrophic. So it's not unlike where military leaders do risk assessments. Where do you place all your attention? Low probability, potentially catastrophic event. That's where we use insurance. And so when we're talking about lifetime value of wealth being potentially $5 million, it's difficult in your 40s, maybe to early 60s, to be underinsured. And so that's where we start to layer on term policies on top. That's point one. Point two is when we start to reach the higher ends of pension benefits, so think lieutenant colonel, retired E9 types, we layer on top of that 100% disability. We layer on top of that they're earning $150,000 to $250,000 annually. All of a sudden, it's difficult to buy enough term insurance to cover it. And so that's where it's, okay, we're going to buy a fairly sizable term policy. We might buy several term policies. They might they might start out with, hey, I've had a $750,000 policy for the last, 10 or 15 years and it expires in 10. Great. We'll add another policy on top of that. Maybe add some group on top of that. And it expires over time. And yes, it might be a little bit less than survivor benefit, but then we can invest the rest. Because ideally what we'd like to do is make sure that messy middle between early 40s to shortly after the kids leave the house and launch, that we have a lot of protection. And during that time, we're investing the difference so that when those term policies expire, there's a sizable enough retirement account that should the worst case scenario happen, the spouse could then live off that without a dramatic dip in standard.
How should couples approach this decision together?
I think that's a great question. I think first they need to start with how the spouse feels about money, like we started with in the beginning. And the second is a real honest discussion about what happens if I pass. And I don't think enough people have this discussion. My wife and I had this discussion, and she has a wonderful corporate job. But she also told me that if something happened to you unexpectedly, I wouldn't want to work for 2 years probably. And the fact of the matter is, I mean, I can't imagine losing a spouse, but you're in your late late 40s, early 50s, you have teenage kids in the house likely. That is truly a catastrophic event. Do you want to put your spouse in a position where they have to be making money-informed decisions right away? Because the fact of the matter is declining SPB and giving your spouse $1 million term policy, you're signing up for your spouse to going back to work within a month of you passing, likely, if you really haven't thought about this.
Military life has a lot of pressure on marriages already.
Mhm.
The deployments, just separations, training, the intensity of it. And then when you retire, that's another major transition, a lot of pressure on a marriage. Should couples think about their relationship uncertainty when they're making the SBP decision? Because unfortunately, a lot of spouses are getting divorced shortly after
Yeah.
retirement or right in the transition. And so, I mean, obviously, the service member, if you're thinking your marriage is uncertain, they have a different perspective. Also, a military spouse would have a different perspective on marriage if it wasn't going so well. So how do you navigate that? Or what's your advice for people that are thinking some things they haven't said out loud yet?
No, that's a great question and a difficult one. And this is probably going to reveal more of my bias than anything else. But this person was with you for 20 years. You likely have children together. I can only speak for me on this, but I can understand not wanting to maybe do a term policy and having them be the beneficiary. But if it's about protecting your kids, well, then maybe the survivor benefit goes to the kids. Maybe it doesn't go to the spouse. But nevertheless, if it's not for the spouse, then think about the family unit. And how do you protect that family unit to ensure that your children are protected? And the other thing that you can do with some estate planning is you could, if you think you're going to be divorced, that term policy, instead of going to your spouse, could go to a revocable trust. You could name an executor of that trust that then when you could provide provisions inside that revocable estate plan to divvy out that money in the way that you see fit to the children, or even your spouse when it comes to making sure the spouse can support the children and have that environment that you want to have. And so this is kind of where it would probably behoove that person to reach out to a financial planner to discuss those options, because there's ways to structure not so much the survivor's benefit plan. That is what it is. And if you were to get divorced, the courts often have a say in what happens there. But if you're concerned about what happens to your life insurance when you pass and there's not a significant other or there's a fractured relationship, that's when you want to bring in an estate planning attorney and look at those different options on how you can structure that estate plan to ensure that that money gets used in a way that you're comfortable with.
Would the same kind of concept apply to couples in a strong marriage, but just have completely different views on electing or not electing the SBP? Is that the same thing? They should maybe seek out a neutral third party to weigh it all out?
I do. Because oftentimes when I see couples that disagree on money, it's because they have different experiences with money in their childhood. And a good financial planner is going to start out the relationship with a discovery process that illuminates those values and discusses how those different values then influence thoughts around money. And when those things can get brought to the surface, oftentimes what I find is that couples can start having more constructive conversations about money, and we can find some middle road with respect to the implementation solutions.
I like that. When should people start evaluating or looking at, are we going to do the SBP or not?
Yeah, that's a great question, because oftentimes I'll get frantic emails, 48 hours before the final out, and it's like, what do we do? And it's like, well, okay,
So don't do that. Do not do that.
don't
Don't
do
wait
that.
48
Don't do
hours
that.
out.
Don't wait 48 hours. I think it needs to happen. You can certainly do it more than a year out, but it's that process of taking stock, all of the assets in your life, and also understanding how you spend money and understanding what's going to be required if the service member passes unexpectedly. What's the current situation like? Did you just move to Washington, D.C., where the average mortgage is $750,000 at least? And did you just purchase a new home? Are the kids in private school? Do we have college fully funded? Does your spouse work? I've got to be honest with you, Lacey. I think if your spouse doesn't work, I think the survivor benefit decision is really easy. I have a hard time with people that decline the survivor's benefit plan, get $1 million term policy, and call it good when their spouse hasn't worked outside of the house in 20 years.
Very good
That money's
point.
not going to last very long. It's really not. And that's why I talk about at the beginning the difference between the two. So not only on top of the differences, they function so differently, right? So the survivor benefit plan, I get it. It's 55%. It's not going to solve all the problems, but it's probably going to be able to keep the lights on, put food on the table. That's why I'm a big fan of layering on the term policy, because you're going to have major expenses that come up right after someone passes that require lump sums. And then you're also going to have kind of your daily bills that have to be taken care of. Because the other thing that people don't consider is, okay, I just had this windfall of term insurance, $1 million, $2 million, whatever it may be. Now, what do we do with that money? Was that spouse the financial spouse? Maybe, maybe not. How do they go about? Now they have to find a financial advisor at the same time they're grieving. And what type of advice do they get? Is it the right advice? Because now you take that windfall of money. If that money doesn't get invested appropriately, it might not last as long as the assumption was going to be. And so there's a lot of complications with that. And so there's lots of conversations that need to happen before we talk about cost. And that's why I want you to develop this framework and make sure it gets out there, because I think the conversation around survivor's benefit plan is inverted. It starts off with cost. 6.5% is really high. And I don't want to be dismissive of that, but there's often, when we talk about survivor's benefit plan and cost, there's no discussion of, well, how long does it take to recoup your cost?
Yes, that's a
In
really good
most
point.
cases, it's like, if you take worst case scenario with respect to survivor benefit and the payment plan, you pay in for 30 years. How long does it take to recoup your cost? On average, it's 3.5 years without considering taxes, reducing that. So oftentimes I hear this discussion around survivor's benefit plan. It's $200,000, $300,000 of your lifetime. They may never use it. That may very well be the case, but the whole point of it, survivor's benefit plan is not an investment. It's insurance. It's an expense. You are protecting something.
Yes, that's a good
But I
point.
think most people would look at it very differently if they really understood that in most cases, your spouse needs to survive you from between 3 to 5 years. And after that, it's all return. It's all benefit. You recoup your entire payment. Because often what I'll see is, when really good marketers will say, well, because of inflation, you may pay $300,000 into survivor benefit plan. Well, completely omit the fact that the pension also adjusts for inflation. So the argument that it's a lot of money kind of doesn't really make any sense when you compare how short a time it takes to be recouped, even in the worst case scenario, where you pay in for 30 years and maybe hopefully you don't pass into your 70s or 80s. Really what that is just really slick marketing. It's not an actual discussion if it's good or not. Because the other reality is, if you were to pass early, your spouse probably receives benefit or return within months. Maybe it's even under a few months if it's really early. So I don't hear that discussed much in the marketing material.
Is there anything else that we're missing from the framework that or just in general you wish more people knew about the SVP decision?
Yeah, I think I'll just foot stomp it one more time. I wish people started out with a discussion of what it is they're going to protect. And then understand that it's not just about saving money. It's about understanding that oftentimes when you're saving money, you're underprotected, you're underinsured. And the second part of that is that might be perfectly acceptable in your situation. I can think of lots of situations where the pension is a size where purchasing a $1.5 to $2 million 20-year term policy is absolutely the right decision. However, in order to make that work, you have to regularly invest your money. So when that term insurance policy expires at age 60, if you pass when you're 65, you have a retirement nest egg where your spouse is not put out an alert.
Well, it is a big decision. I hope all this information, I mean, if you're listening, it's definitely going to help you. But I think you're right. Like, there's a lot of things to start with, and it's a very personal decision that I always tell people, like, you should definitely not do it based off of anything anybody else says. I hear that all the time. Well, so and so did it. I'm like, well, they have a different situation than you do, or they decided not to do it. They have a very different situation than you do. So I love the framework, and I'll be sure to put links in the show notes for everybody to that. I want to switch gears now and ask you a couple of quick random questions I ask everybody. First off, what is one resource or tool that makes your life or your work easier?
So for me, it's Claude Code. It's a combination of Claude Code and a database tool that is called Airtable. It's a no-code database tool. And I am not a computer programmer. And over the last 2 or 3 years, I've been able to build multiple software tools. I have my own custom CRM. I built my own cash flow analysis for my clients, my own meeting notes app. And so it is amazing what Claude Code can do. It can turn pretty much anybody, if it can turn me into a computer programmer, and just the ability to kind of scale all of the back office operations that go into being a financial planner and getting all of this data and trying to synthesize it and get it out to clients, a complete game changer.
I love that. I'm a huge fan of Airtable too. I use it for all my
Yeah,
businesses. So
I saw that. Yeah, no,
yeah.
it made me smile when I saw your.
Yes. What is your favorite book right now, or your favorite book of all time?
So my favorite book series right now is I love trashy spy novels. And so I've been reading all the Gray Man series because when I get done with work at the day, it's hard for me to read like dense, I'll fall asleep in like 5 minutes. And so I can kind of speed through that. It's entertaining. It's just kind of pulp spy novel, and it's just fun.
Yes. I feel like somebody mentioned that series before, but I'll be sure to put a link in the show notes for everybody that's listening. Now it is time for my favorite part of the podcast, which is game time. And today,
All
in
right.
honor of your visit, we're going to be playing fact or fiction. So
Okay.
I'm going to give you 5 random statements, and you have to tell me if it's true or if it's false. If you get 3 out of the 5 correct, you get bragging rights that you won game time on the MILMO Show, which is a
Okay. All right.
really
Let's
big
go.
deal, Kyle. Really big deal. Okay. Number 1. Antarctica's average annual precipitation is higher than that of any other continent. Is that fact or fiction?
Whew. I'm going to go with fiction.
That is correct. It says Antarctica is one of the driest places on Earth.
Got it.
Interesting. Okay, so 1 down. Number 2, oak trees bear acorns in their second summer. Is that fact or fiction?
I'm going to go with fiction.
That's correct. It is fiction. I did not know this. It says that most oaks grow for about 20 years before they bear acorns. I thought that was interesting.
That's a
Okay.
lucky guess.
Yes, but you're 2 for 2. Okay, number 3. A typical pencil contains enough graphite to draw a line 35 miles long. Is that fact or fiction?
Ooh, I'm going to go with fact.
You're really good at this, Kyle. That is a fact.
Hey,
It says it's true. So you have bragging rights, but you have to finish strong.
okay.
Number 4, the Chicago Cubs have never won the World Series. Is that fact or fiction?
That's fiction. I know that. I got
It's true.
that.
I don't know if one's newer since my game, but one in 1907 and 1908. Okay. 4 for 4. Number 5. Jesse Owens won 4 gold medals at the 1936 Olympic Games, but set no world records. Is that fact or fiction?
I'm going to say fiction because I think he set a world record.
You got 100%. It is fiction. It says that he broke 3 of his 4 3 of the events he won world records for out of the 4. So you have bragging rights that you won game
All
time on the
right.
MILMO Show. I appreciate you playing the game and for being here. Can you tell everybody listening where they can learn more about you and the work you're doing?
Absolutely. The best place to find me is on LinkedIn, Kyle Packard. It's where I post regularly about military financial planning topics, and then also my website, packardwealth.com.
I will be sure to put links to that in the show notes for everybody. Thank you again, Kyle. This was great.
Thank you for having me, Lacey.